Sawadeeทุกคน Hi everyone, my name is Edmund and I look after the research team at Nansen as the head of research. As you all may know, Nansen is an on-chain blockchain analytics platform and we enrich on-chain data with millions of proprietary wallet labels. Now, when I was asked to prepare for this talk, we had just witnessed the Lehman Brothers type of situation with the collapse of FTX and Alameda. At the same time, we've seen far-reaching contagion effects, and there are concerns about large players, whether it's exchanges or lenders, market makers, and entire ecosystems. We're worried about their insolvency and the survival of them. Now, given the topic here is about how to onboard masses into crypto with on-chain data as well. So for today's talk, I thought of doing something different and maybe do a bit of reflection about how we got to where we are today. Now, as you can see here, like the flashback to the start of 2020, we saw the arrival of a pandemic, and that sort of led to a pandemic-induced crash in March of 2020. And what followed was the largest expansion of central banks' balance sheet globally in modern history, where the money printer was running over time. And markets quickly recovered, despite the fact that businesses globally were all on lockdowns and unable to sort of do their business. What then followed was a global COVID-induced bull market, starting with equities and tech stocks. Now, during the summer of 2020, we saw the adoption of smart contract-enabled blockchains like Ethereum and the rise of DeFi through yield farming. Food farms became the in thing, and yield farming became the norm. During this period, the term Ponzinomics became popular to describe projects that were launching new native tokens with inflationary emissions, with the aim of providing them as yield farming rewards to attract users. And we also saw the role of interoperability and composability across DeFi applications. Now, with smart contract-enabled blockchains like Ethereum finding some sort of product market fit through DeFi and yield farming, we saw record activity on-chain. Now, this chart here will show you the extent of the congestion that we saw on Ethereum itself. And bear in mind that this shows the median gas prices on Ethereum in gray, not in US dollars. Now, increasingly, more and more users were onboarded on-chain, learning about cryptography concepts like public and private key, as well as setting up their first crypto wallets, trading shitcoins through DEXs and yield farming on protocols like Aave and Compound. As the price of ETH in US dollars sort of breached past its previous 2018 all-time highs, and at the same time, given the congestion that we saw on Ethereum blockchain, it made it incredibly expensive for users to actually transact on-chain. So then we saw the rise of BSC, or now known as BNB chain. It provided a cheaper and lower cost alternative that was more accessible to new users to onboard and participate on DeFi activities on-chain. Now, I won't go into the trade-offs that were made in the creation of BSC, but it clearly became one of the more popular smart contract-enabled blockchains apart from Ethereum itself. Even dwarfing the number of daily active addresses than that versus Ethereum. And at its peak, you can see that the number of daily active addresses on BNB chain was 2x, more than 2x than that on Ethereum. At the same time, it became a lot easier to on-ramp and off-ramp through centralized exchanges like Binance, so the barriers for onboarding new users was a lot easier to join. And at this point, you can truly say that the masses were starting to take notice of DeFi and the opportunities on-chain. Now, we also saw the proliferation of stablecoins as a dominant tool to onboard not just normies who might not want to denominate their net worth in Bitcoin or Ethereum, but also interest from institutional money that wanted to capture the opportunities that were on-chain as well as in this new emergent asset class. Now, this is the time where we can say that the mainstream adoption gravy train was in full force. So we had MicroStrategy and Tesla announcing that they were holding Bitcoin on their balance sheets. We have large funds, traditional funds that were allocating towards crypto now. And at the same time, we even saw Mark Cuban become a degen yield farmer and getting rocked in the process through Iron Finance. And centralized exchanges were printing money left, right, and center with celebrity endorsements. And we even saw a country in El Salvador adopting Bitcoin. Now, many different layer 1s and layer 2 protocols and blockchains became popular as a result of, number one, the high gas fees to transact on Ethereum, as well as the mercenary chase for higher yields through liquidity mining programs that all these new chains were offering to attract new users. Cross-chain bridges became extremely important and popular because these blockchains needed a way to operate and communicate with one another. And just to give a rough idea of the scale, Polygon's proof of stake, ERC20 and Ethereum bridge have seen a combined total volume in of around US dollars 40 billion so far and counting. And the added complexity in the system for cross-chain functionality also led to more and more exploits, as we have seen in the recent BNB chain exploit hack. And then we saw the craze of NFTs. This is where I would say the real mainstream adoption was taking place. NFTs were a much easier concept to sell than DeFi itself. After all, they're just JPEGs on a blockchain. Play to earn became pitched as the next model for gig economy workers. And we saw total NFT marketplaces, the volumes of reaching at its peak close to 1.6, 1.7 billion US dollars worth of ETH in 1 week alone. And that volume continued to sort of be in the same range even at the start of first half of 2022, despite the fact that by this time, the prices of Ethereum and Bitcoin had already fallen past and failed to make its new all-time highs. Now, as Bitcoin and Ethereum failed to breach past its all-time highs, yields started to dry up on-chain, especially stablecoin yields, as more and more so-called smart money players were starting to de-risk and also seek less volatile returns by yield farming stablecoins. In came Terra Luna to the rescue with their algo stablecoin UST, as well as Anchor Protocol, a lending borrowing protocol on Terra that promised 19.5% interest rates on USD deposits. Whilst the rest of crypto were sort of starting on its gradual decline in terms of prices, we can see that Terra Luna became a big outlier that bucked the trend in the first half of 2022. And then came at the start of May, where we saw the collapse of USD and Terra Luna, shallow liquidity on curve pools that were regulating the one-to-one pack of USD and other stablecoins on-chain, led to players arbitraging this vulnerability. And this caused a subsequent depack of USD and the eventual collapse of Terra as an ecosystem. Now, this is what I would call the bear stearns moment for crypto, given Terra's USD's popularity not just on-chain across many different protocols in different ecosystems, but also off-chain, where a lot of the borrowing, lending, and OTC deals were done in UST. Overnight, an ecosystem with a total value of more than 20 billion at its peak was completely wiped out. And little did we know that the first order ripple effects had only just begun. Now, during UST's disintegration, we also saw the contagion spread across to stake ETH, as its peg also suffered from an imbalance in the curve liquidity pool that was between stake ETH and ETH, with droves of wrapped stake ETH in the form of BETH that came from Terra migrating back to Ethereum during the Terra Luna collapse. And this increased selling pressure on stake ETH and in turn likely also pushed many liquidity providers to withdraw their liquidity. The irony is that on-chain, you could see this. The largest stake ETH withdrawals from the main liquidity pool came from, number one, Three Arrows Capital, number two, Hodlonaut, and number three, Celsius, all of whom have now collapsed and descended into insolvency. And you can even see Alameda in yellow here, withdrawing their stake ETH on May the 8th, right at the start of the USD pack. And we even saw the contagion spread to public listed companies like Voyager Digital. They filed for bankruptcy after 3 Arrows Capital had collapsed and defaulted on a $650 million loan. And you can see here that on-chain, you can see Alameda being one of the largest counterparties of Voyager. And this wallet alone, Alameda had received more than $400 to $500 million worth of Ethereum from this one Voyager wallet alone. And here we are today with the collapse of FTT, Alameda, and the subsequent bank run of FTX, the fears surrounding a potential collapse of and bankruptcy of Genesis and DCG, and concerns that the contagion would spread to even more players in the space. You can say that we have truly hit a true crisis of confidence in crypto. What then are the key lessons here? Now, I will say that on-chain data, number one, doesn't lie. All the charts and data that I've showed you are from on-chain data and our analysis. And one point that I want to highlight is the fact that on-chain data is a necessity and it is actionable. It's not just a nice to have anymore. Any fund or investor investing in crypto will need to be proficient in on-chain data, and even more so projects and companies operating in the space. And number two, given the public and anonymous properties of a blockchain, it requires an illuminating compass to guide the way for the masses. As transactions and addresses are all in their own unique hexadecimal values, attribution labeling becomes important and it makes it easier for the masses to understand what's going on. And number three, the contagion is real and quasi-enormous isn't. So here I wanted to highlight the fact that as we get more and more complexity, composability, and sophisticated instruments across DeFi and NFT finance and so on, this will mean that contagion will continue to become a key risk and it will only increase further. Now here, risk management and prudence will be key. And given that the high dimensionality of DeFi and generalized blockchain, added with the fact that there is a non-linear relationship between big actors in the space in the sense that someone like SBF can come and walk away with huge returns, it creates a potential unsustainable dark forest on the blockchain with retail potentially losing at the end. And number four, not your keys, not your coins. So here I want to sort of highlight the importance of self-custody. This is one of the reasons why this space exists in the first place, to get rid of the middleman. And here people will start to understand the importance of holding your own coins, your own assets in your own custody, in your own wallet. And because that will force people to transact on-chain data will become more and more important. And number five, trust, the idea of trust. And trust itself is a very precious gift. So when you pour your heart and soul and energy into transacting on-chain or with a counterparty, you need to also verify. As we have learned so far, bad actors can just pop up and mask themselves as good until the rug is pulled. And here we want to touch upon the concept of triple entry accounting. No longer do we have just an entry between a debtor and a creditor, but now there is a third entry on the blockchain, on the decentralized, immutable, and public ledger that's accessible and open to everyone and anyone. This is the true innovation of Satoshi's Bitcoin and the reason why blockchain exists in the first place. And number six, I'd like to call for more transparency on-chain, not just on-chain, but also off-chain as well. I think the fact that there is not a lot of transparency and credibility in the space is an issue, and I think we have the perfect tool and solution through a decentralized database in the form of a blockchain. Now at Nansen, since day one, our core mission is to surface the signal and to create the future of finance. So what we do is we are the leading blockchain analytics platform, and we combine both high-quality on-chain data together with the largest proprietary database containing more than 200 million wallet labels and growing. We help users to navigate through the dark forest of the blockchain with our comprehensive, user-friendly analytics dashboards and labels. And this is to give users seamless on-chain data with real-world context to number one, make it easy to analyze and understand anonymous wallets, sort of help them with their on-chain tracking, and also number three, provide them a user-friendly interface without needing SQL or technical knowledge. Every crypto wallet, as I mentioned earlier, has a unique address that's anonymous, and having these wallet labels gives you an idea of who is carrying out transactions on top of having visibility of them. And this gives you more clarity and insights on what's going on. And here's an example of a wallet label you get from the right-hand side, from that OXD387 to this wallet that shows you a smart money emoji with Pranksy's name on it. So this is Pranksy's wallet. It's one of the more notable NFT collectors in the space. At the same time, you are also able to understand through on-chain data the behaviors of ecosystem actors and players. So for example, like what has smart money players been accumulating? How much stablecoin percentage are they allocating in their portfolio? For NFTs, for example, like what's the breakdown between buying and selling activity per week? Or how many buyers are returning or first-time NFT buyers? And if you're curious as well, you can also take a look and see what tokens smart money wallets are holding. Or if, let's say, you're trying to figure out what are early GMX token stakers trying to do, or what they're investing as well, apart from just GMX. And you can see here, from on-chain data, you can see straight away that they are diversified across other different decentralized applications like Convex or Uniswap. Or let's say if you want to ask what kind of verticals do they interact with, majority of them, as you can see, they interact mainly in DeFi, followed by centralized exchanges, and then NFTs and bridges. Or if you want to understand market behavior, here you can see exchange flows and counterparties in the last 30 days, and their withdrawal volumes from centralized exchange. And you can spot the odd FTT transactions and withdrawal volumes from FTX here. At the same time, you can also use on-chain data to find opportunities and unearth them on-chain. For instance, we have this dashboard here that shows you undervalued NFT listings that you could potentially sort of snipe and try to flip. And more importantly, on-chain data gives you a way to do due diligence and also to play defense with risk management. So when I say perform due diligence on a token or an NFT, things are such as like, identifying what are top token holders doing with their tokens. Are they cashing in or are they buying more of them? How long are holders sort of holding onto their tokens, or how many unique addresses are currently holding token ABC or XYZ? And you can also get real-time alerts on-chain with our smart alerts. So it allows you to react quickly to market changes, and you can change and customize the parameters to your liking. For instance, during the Terra USD crash in May, one Nansen customer was able to save at least tens of millions of US dollars thanks to a smart alert that they had put on the curve USD pool imbalance that I had described earlier. And at the same time, you can also track your portfolio for free at Nansen Portfolio. And we have portfolio coverage across 500 different protocols across close to 50 chains by now. It combines a human-readable transaction interface with our proprietary wallet labels and wallet profiler analytics, and it gives you the best on-chain portfolio and explorer tool. And lastly, if you're keen to learn more about the work that my team and I do check out our research portal at research.nansen.ai. And if you have any questions about Nansen or you want to learn more about what we do and what we can offer, do reach out after this presentation. And with that, I will conclude my presentation and thank you all for listening. ขอบคุณมากครับ